Thanks for joining me. Today we're talking about the RBA and the cash rate. For most of you it's about as exciting as watching paint dry. But the RBA uses the cash rate as a lever to navigate through varying monetary and financial conditions to hopefully achieve the objectives of a stable currency, full employment and sustainable economic growth. The RBA cash rate is primarily used to control inflation, which is the rate at which the general level of prices for goods and services rises over time. The targeted consumer inflation rate is between 2 and 3%. When the cash rate falls, it generally acts as a stimulus to the economy, and you will see that the share market rises after a rate cut or in anticipation of a rate cut. The opposite is true when rates rise, as this generally acts to slow an economy, with borrowers having less money to spend, as they're now paying higher interest rates on their borrowings. In the past, major financial institutions have generally adjusted their interest rates in line with the RBA cash rate movements. However, this is no longer necessarily the case, and the banks are under no legal obligation to pass on the rate cuts or rises to their customers. Whether or not they will pass on the cuts depends on the impact which the RBA rate change has on their funding costs. There are winners and losers with any movement in the cash rate. Although it's a pretty dry topic, the RBA and the movement of cash rates, it has an important impact on you. So it is worthwhile at least taking a passing interest in it. If you have any questions, please don't hesitate to contact us.